Okay, let's talk Mission Produce. Their latest earnings report, it's a really interesting one, and probably not for the reasons you'd think just by glancing at the headlines. On the surface, you might think, ouch, that looks rough. But when you actually dig in, you see a company that's just executing incredibly well. So let's break it down. So this slide, this really tells the whole story in just two numbers. It's kind of wild. On the one hand, the average price they could sell an avocado for, it cratered, down 27%. That's a huge drop. But then you look at the other side, and their adjusted earnings per share, they didn't just beat Wall Street, they absolutely demolished the consensus estimate, up almost 60%. So how on earth do you do that? How do you make more money when the price of your main product is falling off a cliff? That's the puzzle we're going to solve. All right, first up, let's just look at the earnings snapshot, the headline numbers versus what Wall Street was expecting. Okay, so check this out. Revenue came in strong at $319 million, which was a solid beat, more than 8% above what analysts were looking for. But the real showstopper, the number that made everyone sit up and take notice, was that adjusted EPS. They printed 31 cents a share. The consensus was for what, 19.5 cents? That's just a huge beat. Now, yeah, on a GAAP basis, there was a tiny miss, but honestly, nobody cared. The market was laser-focused on how well they operated the business, and that adjusted number tells the story. And I really want to drive this point home. Beating expectations by over 11 cents a share, that is not a small thing. It's not a rounding error. That's a massive signal to the market that says, hey, we know how to run our business. We've got our costs under control, especially when you're facing that kind of pricing pressure. So what did the stock do? Well, it reacted positively, but it wasn't some huge pop. The stock moved up a pretty modest 1.7% after hours. And what that tells you is that investors are giving them credit. They're rewarding the fantastic execution. But they're still a little wary about the overall price of avocados. This wasn't the market betting on a huge price recovery. It was the market giving a hat tip to a company that's just running its operations incredibly well. Okay, so this gets us to the really important part. How did they pull this off? How did volume manage to beat price? So first, you have to appreciate the headwind they were sailing into. A 27% drop in your average selling price is a really big deal. And this wasn't their fault. It was an industry thing. You had a ton of supply coming out of Mexico, and the harvest in Peru came back in a big way. So the market was just flooded with avocados. And that, of course, pushed prices down for everybody. But here's the counterpunch. Here's how they fought back. They used their massive global network to sell 13% more avocados. It's a classic playbook, right? If you're getting less for each item, you just have to sell a whole lot more of them. And that's exactly what they did. And look, this wasn't some accident or a one-time trick. This is their entire game plan. The incoming CEO, John Pawlowski, said it perfectly on the earnings call. He said, "We are a volume-centric business. Volume and per-unit margins are the metrics we manage to." And that's the key takeaway right there. They can't control the global price of avocados. No one can. But what they can control is how many they move through their system and what kind of margin they squeeze out of each and every one. Now, this focus on operations isn't just about this one quarter. It's really getting baked into the company's DNA for the long haul, which brings us to a really important announcement they made about a changing of the guard. And what's great here is that this is a super smooth, well-planned transition. You've got the founder and CEO, Steve Barnard, the guy who literally built this company over 40 years. He's going to become the executive chairman, and he's handing over the CEO job to John Pawlowski, who's already the president and COO. It all happens in April 2026. This is exactly what you want to see as an investor: stability and clear continuity at the very top. Okay, let's switch gears to what I think is maybe the next big reason to be watching this stock. And it all has to do with free cash flow. This is a huge story. So, for the last few years, Mission has been spending a lot of money. They've been in this heavy investment cycle, building out all their infrastructure around the world. Well, guess what? That cycle is basically over. Their capital spending, what we call capex, is set to drop pretty significantly. It was over $51 million last year, and they're guiding to around $40 million for fiscal 26. And when your spending goes down like that, it means a ton more cash is about to get freed up. A wave of free cash flow is coming. So the big question is, what are they going to do with all that extra cash? Well, management gave us a pretty clear roadmap on the call. Priority number one is still growth, both growing the business they have and maybe looking for some smart acquisitions. And because their balance sheet is so strong, with hardly any debt, they have a ton of flexibility to do that. Oh, and they also made it clear that share buybacks are definitely an option for returning some of that cash directly to shareholders. All right, so let's wrap this all up. You've got incredible execution, a smooth leadership change, and a huge free cash flow story about to kick in. Let's get to the next call, our thesis, reading, and price target. So here's the bottom line question for anyone looking at this stock. Can they keep up this amazing margin execution when the whole industry is swimming in avocados and dealing with low prices? Because based on what management is saying for next quarter, that pressure is not going away. So our call here is an outperform rating, and we're setting a price target of $16. Here's the thesis in a nutshell. We believe the company's operational skill and its sheer global scale act like a protective moat, allowing them to defend their profits. And that huge inflection in free cash flow, that's a clear, powerful catalyst that should drive the stock higher. Now, for the very next quarter, we're expecting more of the same story. Look for really strong volume growth to fight against pricing that's probably going to be down, maybe around 25% again. And as always, this is not financial advice.